Your retirement account could lose half its value in the next 18 months. Your home, the one you worked decades to pay off, could be worth less than what you owe. And your savings, the money you put away for your children's future, could vanish overnight. This isn't fear-mongering. This isn't speculation. This is pattern recognition. And the pattern has been right. Twice before. I'm Walter Grant, and welcome to Draxiver. What I'm about to show you is a documentary analysis of a crash that hasn't happened yet, but follows a pattern that has happened twice before with devastating accuracy. In 1929 and in 2008, the exact same conditions existed. Extreme valuations, record debt, excessive leverage, and a widespread belief that this time is different. Right now, in 2025, every single one of those conditions exists again. Not similar conditions. Identical conditions. The stage is set. The players are positioned. And if history is any guide, the crash will come in late 2026 or early 2027. Now let me show you exactly how crashes unfold. Who loses everything? Who profits enormously, and why the 2026 crash could be worse than 1929 and 2008 combined. Because the scale is larger, the leverage is higher, the interconnection is deeper, and the people in power, have already used all their ammunition fighting the last crisis, leaving nothing in reserve, for the next one. Let me start with where you are right now. January 2025. The setup. Every crash begins with a bubble. And right now, you're living inside the largest everything bubble in history. But here's what they're not telling you on the evening news. It's not just stocks. Real estate in major cities is at all-time highs. The median home price in America is $420,000. The median household income is $75,000. That's a ratio of 5.6 to 1. Historically, sustainable ratios are 3 to 1. At 5.6. Housing is 87% overvalued relative to incomes. In 2006, before the housing crash, the ratio peaked at 5.0. We're higher now. Corporate debt is at record levels, $13.5 trillion, 72% of GDP. In 2007, it was 43%. Government debt is $36 trillion, 120% of GDP. And your fellow Americans, they're drowning too. Credit cards, auto loans, student loans, totaling over $17 trillion. Add it all up, government, corporate, household, financial sector. Total debt in the U.S. economy exceeds $90 trillion. That's over 320% of GDP. Every sector is leveraged beyond historical norms, simultaneously. This is the everything bubble. Everything is expensive. Everyone is in debt. And everyone believes prices will keep rising forever. But here's the question you need to ask yourself. Do you really think this party can last forever? Why does everyone believe prices will keep going up? Because for 15 years since 2009, the Federal Reserve has guaranteed it. Every time markets started falling, the Fed cut interest rates, or printed money, QE1, Q2, QE COVID stimulus. The Fed printed over $8 trillion from 2008 to 2022. This money flowed into assets, driving prices higher. And you learned a simple rule: buy the dip. The Fed will save you. This conditioning created something dangerous: moral hazard. You stopped fearing risk because risk was eliminated by central bank intervention. But there's a problem, and it directly affects your financial future. The Fed has used its ammunition. Interest rates were at zero for a decade. They can't go lower. The balance sheet expanded from $800 billion in 2008 to $9 trillion in 2022. There's no room for more expansion without triggering inflation. And inflation already happened in 2021 and 2022. The Fed fought it by raising rates from 0 to 5.5% in 18 months, the fastest rate increase in 40 years. This stopped inflation, but it created a trap. If rates stay high, your debt becomes unpayable. Corporate debt issued at 3% must be refinanced at 7%. Mortgage at 3% are now 7%. But if the Fed lowers rates, inflation returns. They're stuck. And so are you. This is the setup. Maximum valuations, maximum leverage, and a Federal Reserve that has nothing left for the next crisis. Now, let me show you how this compares to 1929 and 2008, because the patterns are identical. In 1929, the stock market had risen 400% from 1924 to 1929, a 5-year boom. Margin debt, borrowing to buy stocks, reached 10% of GDP. Everyone was leveraged. Everyone believed stocks only go up. The phrase permanently high plateau was used by economists in 1929 to describe the new era where crashes were impossible. Then October came. The market fell 89% over 3 years. In 2008, the housing market had doubled from 2000 to 2006. Mortgage debt reached 100% of GDP. Everyone was leveraged, buying houses with subprime loans. Everyone believed housing prices never fall nationally. Then the subprime mortgage started defaulting. The financial system collapsed. The S&P fell 57%. In both cases, the setup was the same. Asset bubble, excessive leverage, widespread belief in permanence, then a trigger, and then cascading liquidation. The 2026 crash will follow the same pattern. We have the bubble. We have the leverage. We have the belief that Fed intervention makes crashes impossible. All we need is the trigger. Let me show you the 3 most likely triggers and how each one could start the cascade that wipes out your savings. Trigger 1. Commercial real estate collapse. This is the most likely trigger because it's already underway. Office buildings across America are 40 to 50% vacant due to remote work. Companies that used to lease 5 floors now lease 2. This is permanent. Remote work isn't going back to 2019 levels. These buildings were financed with mortgage at 3% interest rates. Those mortgages are maturing now and must be refinanced at 7 to 8%. The math doesn't work. Building owners are walking away. Brookfield Asset Management, one of the largest real estate owners globally, defaulted on 2 Los Angeles office towers in 2023, just stopped paying. Gave the buildings to the lender. Over $2 trillion in commercial mortgage mature between 2025 and 2027. If 30% default, that's $600 billion in losses. And who holds these mortgages? Your local banks. Regional banks, community lenders. They hold 20 to 40% of their loan books in commercial real estate. When those loans default, banks must recognize losses. Those losses eat through capital. When capital falls below regulatory minimums, regulators close the bank. We've already seen this begin. Silicon Valley Bank collapsed in March 2023. Signature Bank failed the same week. First Republic failed in May 2023. If commercial real estate defaults cascade through 2025 and 2026, we could see 50 to 100 regional bank failures, and bank failures trigger panic. Your panic. Trigger 2. A major corporate bankruptcy or sovereign debt default. Hundreds of corporations issued debt at low interest rates during 2020 and 2021. That debt is maturing now. They must refinance at rates that are double or triple what they paid before. Some cannot afford it. If a major corporation, a Fortune 500 company, defaults on its bonds, it triggers contagion. Bond investors panic. They sell other corporate bonds. Yields spike. Borrowing becomes impossible. More defaults follow. This is exactly how the 2008 crisis spread. Lehman Brothers failed. Then everyone assumed other banks would fail. Credit markets froze. The same thing could happen with corporate debt. And it could happen to companies you trust with your retirement. Trigger 3. A geopolitical shock. War, pandemic, terrorist attack. Election crisis. Something that spikes volatility and forces investors to sell everything to raise cash. The COVID crash in March 2020 was this type of trigger. The pandemic wasn't an economic problem initially. It was a health crisis. But the uncertainty forced liquidation. When you don't know what's coming, you sell everything and go to cash. If another shock of similar magnitude occurs, war with China over Taiwan... Conflict in the Middle East disrupting oil supplies... A contested U.S. election with violence. Any of these could trigger the same flight to safety that wipes out your portfolio. Any of these three triggers could start the cascade. But the underlying cause is the same. Excessive valuations and leverage. The trigger doesn't matter much. Once liquidation starts, the mechanics take over. And those mechanics are brutal... predictable... and devastating to your wealth. Let me walk you through what happens once the crash begins, so you know exactly what's coming for your money. Phase 1 is the initial shock. The trigger event happens. Markets fall 10 to 15% in days. You're surprised but not panicked. You've seen dips before. This feels like a buying opportunity. Buy the dip. The Fed will intervene. Stocks are on sale. Media outlets interview analysts who say fundamentals are strong and this is temporary. In 1929, the initial shock was October 24th. Black Thursday. The market fell 11% in one day. Bankers met and pledged to support the market. Stocks recovered slightly. Everyone believed the worst was over. In 2008, the initial shock was March 2008 when Bear Stearns collapsed. The market fell 15%. The Fed arranged a bailout. Crisis averted. Or so everyone thought. In 2026, the initial shock could be a major bank failure or a wave of corporate defaults. Markets fall 10 to 15%. The Fed issues a statement. We are monitoring the situation. The financial system is strong. We stand ready to provide liquidity. You buy the dip. Stocks recover partially. But the damage is done. The crack in confidence has appeared. Phase 2 is a false recovery. This is the most dangerous phase because it convinces you the worst is over. After the initial shock, markets stabilize, maybe even rise. This lasts weeks or months. In 1929, after Black Thursday, the market recovered for a week. By early November... stocks were nearly back to pre-crash levels. Investors who sold felt foolish. Those who bought the dip felt vindicated. Then November 11th arrived. The market fell 13% in a single day. The real crash had begun in 2008 after Bear Stearns collapsed in March... Markets stabilized through spring and summer. By July 2008, the S&P was only down 10% from its October 2007 peak. Many analysts called it the bottom. The financial crisis is contained. Housing has stabilized. Then September arrived. Lehman Brothers failed. The market fell 40% in 6 weeks. In 2026, the false recovery could last 3 to 6 months. The initial failure is blamed on specific mismanagement. It's isolated. It doesn't reflect the broader economy. The Fed cuts rates modestly. Markets rally. You believe the crash is over. But beneath the surface, the problems are spreading. And your portfolio is about to get destroyed. Phase 3 is the cascade. This is when the real crash happens. Forced liquidation, margin calls, panic selling. Here's exactly how it destroys your wealth. Stage 1. Leveraged investors get margin calls. Anyone who borrowed to buy stocks is forced to sell when stocks fall. The broker issues a margin call. Sell now, or we'll sell for you. Stage 2. Institutional investors face redemptions. Mutual funds, hedge funds, pension funds. When their assets fall, investors demand their money back. The funds must sell stocks to raise cash. More selling pressure on your holdings. Stage 3. Algorithmic trading amplifies the decline. High-frequency trading algorithms see prices falling and accelerate the selling. Stop-loss orders trigger. Circuit breakers halt trading. Which creates more panic when trading resumes. Stage 4. Liquidity disappears. When everyone is selling and no one is buying. There are no bids. Stocks gap down 10, 20, 30%. Because there's no buyer at any reasonable price. The market isn't declining, it's collapsing. Stage 5. Credit markets freeze. Banks stop lending. Why lend money when borrowers might go bankrupt tomorrow? Companies that need to refinance debt cannot. They default. Banks that lend to those companies take losses. The cycle accelerates. During the cascade, the economy enters recession. Your 401k could lose 50 to 70% of its value. About $30 trillion in market value could be destroyed. You feel poor. You cut spending, companies lose revenue. They lay off workers. Unemployment rises from 4% to 9 or 10%. Laid off workers cut spending further. More companies lose revenue. More layoffs. This is the feedback loop that turns a market crash into an economic depression. Phase 4 is maximum panic. This is the bottom. When fear is so extreme that everyone sells everything regardless of price. In 1929, the panic bottom was July 1932. The Dow at 41, down 89%. Unemployment at 25%. In 2008, the panic bottom was March 2009. The S&P at 666, down 57%. Unemployment at 10%. Major banks insolvent. In 2027, the panic bottom could see the S&P fall to 2,000 or lower. Unemployment at 10%. Multiple bank failures. Government intervention. This is the moment of maximum fear. But here's what they won't tell you. It's also the moment of maximum opportunity. Phase 5 is the slow recovery. The government intervenes massively. In 1933, Roosevelt launched the New Deal. The recovery from 1929 took a decade. Stocks didn't reach 1929 levels again until 1954, 25 years later. In 2008, the government bailed out banks. The Fed printed $3 trillion. Congress passed stimulus. Stocks reached new highs by 2013. In 2027, the government will intervene again. But the scale will be larger. The Fed will cut rates to zero. Congress will pass multi-trillion-dollar stimulus. Banks will be bailed out. But the recovery could be slower because government debt is already at 120% of GDP. Adding trillions in stimulus pushes it to 150% or 180%. Your taxes will rise. Inflation will erode your purchasing power. Austerity may cut programs you depend on. Stocks might not reach 2025 levels again until 2032 or later. Now here's the part that should make your blood boil. Every crash creates massive wealth transfer. From people like you who don't see it coming to those who do. Who gets destroyed? You ... if you're holding stocks and homes through this crash. In 1929, middle-class families that felt wealthy in 1928 were destitute by 1933. Their portfolios fell 89%. Their homes were foreclosed. In 2008, middle-class homeowners who bought at the peak lost 40 to 50% of home equity. In 2026, if you have a $500,000 retirement account ... it could become $200,000. Decades of your savings ... gone. If you bought a home recently at peak prices, you could see its value fall 30 to 50%. Your $600,000 home becomes $400,000 or less. If you're 65 years old in 2026 with $800,000 saved for retirement and it becomes $300,000, you don't recover. You don't have decades to wait. Small business owners go bankrupt. When consumers stop spending, businesses lose revenue. They cannot pay rent, cannot pay employees. They close. In 2008, 170,000 small businesses closed. In 2026, the number could be higher. Restaurants, retail stores, service businesses, gone. Owners lose everything. Their businesses, their savings, often their homes, used as collateral for business loans. But here's the critical question you need to answer. If someone is losing all this wealth, who's getting it? Because every crash makes someone very rich. In 1929, Joseph Kennedy made $50 million, equivalent to several hundred million today, by shorting stocks. Bernard Baruch held cash and gold, bought assets at depression prices, emerged wealthier than before. In 2008, John Paulson made $20 billion betting against subprime mortgage. Michael Burry made $700 million. Warren Buffett made billions buying Goldman Sachs and Bank of America at crisis prices. In 2026, the same playbook will create the next generation of billionaires. Who profits? Cash holders. The investors who sold stocks before the crash and held cash or treasury bills. When stocks fall 60%, cash doesn't fall. It gains purchasing power. You preserve capital while others lose half. Then at the bottom, when everyone else is panicking, you deploy that cash. You buy stocks at 40 cents on the dollar. You buy real estate foreclosed at 50% of peak value. Warren Buffett held $325 billion in cash in 2024. When the crash comes, he deploys. He could make $100 billion or more. Short sellers profit. If you short a bank stock at $50 and it falls to $5, you make $45 per share. Hedge funds are building these positions right now. They'll make billions. Gold holders profit. In 2008, gold went from $800 to $1,900 by 2011, a 137% gain. In 2026, gold could go from $2,700 to $5,000 or higher. Because when the crash comes, the Fed prints money. Massive stimulus that devalues the dollar. Gold, which cannot be printed, appreciates. Distressed debt buyers profit. When companies go bankrupt, their debt trades at 10 to 30 cents on the dollar. Vulture funds buy this debt, wait for restructuring, collect 50 to 100 cents. A $100 million investment becomes $300 million. Private equity firms profit. They've raised $2 trillion in dry powder, capital waiting to be deployed. When the crash comes, they buy companies being liquidated at 30 to 50 cents on the dollar. This creates generational wealth. This is the wealth transfer, from the middle class holding stocks and homes through the crash, to elite investors who sold before, shorted during, and bought at the bottom. It's not theft. It's not illegal. It's understanding the cycle. Crashes don't destroy wealth. They transfer it from those who don't see it coming, to those who do. Let me give you the timeline. This isn't a prediction of exact dates. This is pattern-based projection. Early 2025, we're here now. Markets at all-time highs. Valuations extreme. Leverage at records. Mid-2025 to early 2026. The trigger event, bank failures. Corporate bankruptcy, geopolitical shock. Markets fall 10 to 15%. Phase 1. Spring 2026, false recovery. Markets stabilize. Media declares the crisis over. You buy the dip. But the problems are spreading beneath the surface. Summer to fall 2026, the cascade begins. Defaults accelerate. Credit freezes. Markets enter free fall. Fall 50% over 6 to 9 months. Late 2026 to mid-2027, panic bottom. Unemployment at 10%. Banks failing. Government intervention. This is the moment of maximum fear. Late 2027 to 2030, slow recovery. Markets stabilize then rise. Economy recovers slowly. But stocks don't reach 2025 levels again until 2030 or later. This timeline could compress or extend by months, but the sequence is locked. The pattern says the crash happens late 2026 or 2027, and the pattern has been right twice before. So what should you do with this information? This is not financial advice. I'm not a financial advisor, but pattern recognition suggests strategies based on what worked in 1929 and 2008. 1. Reduce your stock exposure. If you're 100% invested in stocks, consider reducing the 50 or 60%. Hold the rest in cash or treasury bills. You might miss some gains if markets rise, but you'll preserve your capital when they crash. 2. Consider holding 5 to 10% in gold, physical or ETFs. When the crash comes and the Fed prints money, gold will surge. 3. Identify quality companies you want to own. Make a list. Apple, Microsoft, Berkshire Hathaway, Visa, Johnson & Johnson. Companies with strong balance sheets and low debt. When the crash happens, when these stocks fall 50%, that's when you buy. 4. Prepare yourself psychologically. The hardest part isn't the strategy. It's having the courage to buy when fear is maximum. In March 2009, it felt like the world was ending. Buying stocks felt insane. But that's when fortunes were made. Prepare mentally now, so you can act when the moment comes. 5. Protect your income. If layoffs are coming, make yourself valuable. Reduce your personal debt. Build an emergency fund. If you lose your job during the crash, your savings will keep you afloat. 6. Watch the indicators. Commercial real estate default rates. Regional bank stocks. High-yield bond spreads. These will signal when the cascade is starting. When you see these indicators deteriorate, it's time to get defensive. The 2026 crash isn't certain. It's possible the Fed engineers a soft landing, that valuations gradually normalize, that leverage unwinds slowly instead of explosively. But the pattern says otherwise. Twice before, when conditions align like they are now, crashes followed. Devastating crashes that destroyed the unprepared and enriched those who saw it coming. The setup is complete. The bubble is inflated. The leverage is extreme. The belief in permanence is universal. We're waiting for the trigger. And when it comes, the 5-phase pattern will play out. Initial shock, false recovery, cascade, panic bottom, slow recovery. Wealth will transfer from the middle class. To those positioned correctly, lives will be destroyed, fortunes will be made. And in 10 years, economists will write papers analyzing why no one saw it coming, even though the pattern was obvious. So now you have a choice. Ignore the pattern and hope this time is different. Or recognize the pattern and position yourself accordingly. The pattern doesn't guarantee the crash. But the pattern has been right twice before. And the pattern says late 2026 or 2027. The crash comes. The Great Depression, the financial crisis. And coming soon, the 2026 crash. 3 times. Same pattern, same sequence, same wealth transfer. The only question is, will you be the one who saw it coming, or the one who learns the pattern the hard way? History is clear. Those who understand the pattern survive and profit. Those who ignore it, lose everything. The setup is complete. The pattern is repeating. The crash is coming. What you do with this information will determine which side of the wealth transfer you're on. I'm Walter Grant, and this has been Draxiver.